On today's Hot Sheet, I'm discussing the FOMC statement and their projections, Jerome Powell's comments directly on housing, and the producer price index, the PPI, as well as weekly unemployment. Today is Thursday, June 13th, 2024. I am Byron Lazine, and the Hot Sheet starts now. Okay, the morning after, big day yesterday, we had CPI. Go back and listen to yesterday's Hot Sheet if you want an update on what happened there. And we also had the Jerome Powell press conference yesterday. So we've got the J. Powell analysis, as I see in the comments, the updates on all things Jerome Powell and the FOMC as we open the day today, 9:30 a.m. Eastern time. We see that the Dow is basically moving sideways along with other markets. The Dow was up just a tick. Now it's not giving me the update here. Let's take a look here. All right, not going to give me the update, but it was moving sideways here. And as well as the NASDAQ, just kind of holding steady. We did have a good number on inflation. Now it looks like the Dow is down just a tick. S&P is up a tick. NASDAQ is also up a little bit. But for the most part, moving sideways. After that good inflation read yesterday, we've got another inflation update. But before all of that, what did Jerome Powell say to basically keep the markets where they are, not moving them much? Well, the first thing he said was, we are not changing the federal target rate. Federal target rate remains unchanged. But he had bigger news than that. He went on to say that we should expect maybe, possibly, hopefully, one federal rate cut this year. So earlier in the year, he would talked about 3. We saw the markets really move in an excitable way off of that statement. That statement is nowhere in his vocabulary at this time. The FOMC committee met on Tuesday. They met on Wednesday. And now the talking points are 1 cut this year. Right now, the federal funds rate sits at 5.25 to 5.5. They expect at the end of the year that number will be close to 5.1 on the federal funds target rate. Okay, 5.1. So 1 cut by the end of this year. But what should we expect in 2025? Well, he didn't give us a number of cuts. Wouldn't commit to that. He's already been wrong on what he projected this year with 3. Now, obviously, we might only get 1 before the end of the year, or that's at least their feeling here as we're at the midpoint in the year. But as we look to 2025, Jerome Powell and the committee expect that 5.1 will look like 4.1 by the end of the year. And then by the end of 2026, we could be back to 3.1 on the Fed funds rate. Now, that's probably a lot slower and smaller decreases than some have hoped for. But it's in line with exactly what we've been talking about here on the Hot Sheet for the last 6 months. Expect rates to be higher for longer. Expect a prolonged 30-year fixed to be higher than we would potentially like. Okay, that spread could hopefully continue to get better as it has this year between the 10-year and the 30-year. And hopefully that'll help out. But we're not going to get that infusion from the Fed. Okay. He also went on to say economic activity has expanded at a solid pace. So he's comfortable there. Job gains have remained robust. We saw that last week, which has kept unemployment rate low. We have an unemployment day update today, which wasn't, he didn't have that data to factor in. Inflation has eased over the past year, remains elevated with modest progress towards the 2% objective. So they haven't seen enough progress here. Okay, of course, he gave us more information on what they'll continue to do in terms of security holdings. They're going to continue to reduce security holdings. What does that mean? Their balance sheet is going to get smaller. There's going to be less money in the system, less money for banks. One of the reasons we're nowhere near a 2008 crisis timeframe, banks don't have anywhere near the capital to deploy into that mortgage market that they did back then. I mean, a lot more cautious. When you're a lot more cautious, less money to lend, you're going to be more picky and choosy who you lend that money to. Projections cover real GDP growth, unemployment rate, and the inflation for the 2024 to 2026 and over the longer run. So when they're talking about projections, they're talking about the projections based on where I said that rate would go: 5.1 to the end of the year, 4.1 the end of next year, and then 3.1 the year after. Obviously, the committee is committed to their mandate from Congress. Their mandate from Congress has nothing to do with lowering rates. It is get inflation to 2%. Okay, it's also to maximize employment. So nowhere in there does Congress care about the things that we care about, which is more people generating lifetime wealth through home ownership, or the stability that owning a home can bring, or the vitality of the housing market and how it impacts so many jobs and such a big portion of the GDP. Not really Jerome Powell's concerns, but there are a bunch of moments here where he did mention housing or was asked a question related to housing. So let's now go to his press conference and the question and answer portion of the press conference, where Jerome Powell did cover housing. In his opening statement, which I will read, he mentioned housing just one time. It took about 4 or 5 minutes in. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Okay, so that was that on housing in the opening statement. Didn't address housing at any other time in the prepared statement. The committee decided today to maintain the target range for the federal funds at 5.25 to 5.5. Okay, and continue reducing our security holdings, which is basically again shrinking the balance sheet for the Fed, the money supply. Okay, now let's go to the Q&A. It took Michael McKee from Bloomberg Radio and Television to ask the first question about housing. This is about 29 minutes in. By the way, if you're a BAMX member, everything that we've got here with Jerome Powell's prepared statements and the decisions, it's all available for you. All the timestamps available if you want to refer these to anybody or somebody's asking you about rates. It's all available for you inside of BAMX. So you could just take that clip or that statement. We have it both transcribed and the clip for the video, both directions. You could take that and send that to somebody who's asking you about rates. Hey, I think I'm going to wait for rates to come down. Really, what makes you say that? How certain are you that they will? What's your experience been in following rates? Well, what's your experience been when you see rates come down? What happened before that? Okay. I would maybe include some of the things that Powell's saying. Doesn't look like they're coming down anytime soon. So let's go to Michael McKee's question. Bloomberg Radio and Television. This is during the Q&A portion of yesterday's press conference.
We're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Good news that the banking system is in good shape for now. Obviously, that remains to be seen when some of these commercial buildings come due. We're hopeful, obviously, the banking system will remain in that good shape. What he said there at the top, the housing situation is a complicated one. I really actually like that terminology for agents and investors and people in the housing industry trying to explain it to someone who's not following it. I think Jerome Powell has a pretty good script there. Instead of what we hear some agents, the market is crazy. There's no homes. That just creates like, there's no homes. Why would I want to look then? I want to look at air. I think I like what Jerome Powell said there. The housing situation is complicated. What's your experience been with navigating one of these markets? These are the type of questions you could be asking people right now. Or if they bring up rates. Hey, I want to wait for rates to come down. Jerome Powell just mentioned yesterday that the housing situation is complicated right now. What's your experience been in waiting for rates? How certain are you that they will come down? These are questions that you want to ask so that you can start to really uncover what their level of interest is, why they're interested, why they have a need to be interested in housing right now. Certainly Jerome Powell doesn't believe this is a normal market. So he wants the market to continue to normalize. He's calling this real estate recession a normalizing of the market. Well, when someday rates do come down, it would appear more than likely that we go back to a abnormal market, meaning higher levels of competition. Powell said in there, no matter what, we had a shortage before the pandemic. We had a shortage of housing during the pandemic. We have a shortage of housing now, especially at affordable price ranges. So if the market goes back to abnormal, lower rates, what everybody's waiting for, that's going to be a much more complicated situation to navigate because you're going to be navigating more offers, more competition like we saw in 21 and 22. I think that's important for people to understand. When you're waiting for rates, what exactly are you waiting for? Are you waiting to get back into the ring with 30 or 40 offers? Is that something that's enticing to you and your family and your situation? Is that the road that you want to go down? If it is, hey, cool, I'm here for you. But here's what we've seen in the past. Here's what those markets look like. Okay, now we've got a question from Christopher Rugabeer from the Associated Press. This is right after the McKee question from Bloomberg. Let's go to Christopher Rugabeer, Associated Press.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand. And, we've taken some signal from that, but, and of course, housing services, you're continuing to see high readings there. To some extent, that's catch up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases.
Okay, so a couple things there that you're going to pull out there. Obviously, talking about housing services, we saw yesterday in the CPI, housing is still driving the majority of inflation. And it's very difficult road here to get inflation down to the 2% target. In fact, there's projections that we won't get there until sometime in 2026, whether those come true or not. Certainly the way they're reading into inflation, you could see that path being a likely scenario. You can go back, listen to yesterday's hot sheet, and do the rewatch here on YouTube, or if you listen on Apple or Spotify, it's obviously available there to get the information on the CPI stuff. But the other thing he mentioned here is the labor market has come into a better balance, but he points out that wages are basically too high for his liking. He said it much nicer, but what he's saying is he thinks wages and wage growth is too high. We've heard over and over and over again, we're not going to see rates come down substantially from the Fed until we see the labor market break. At the end of the show, I have a unemployment update for this week. But we're not going to see the Fed really cut rates until they're forced to, because the second part of their mandate is maximize employment. So what he's saying there is we're concerned about people making more money because that pushes prices up. It's an inflationary measure. There's a balance that they're trying to do. People losing their job would force the hand of the Fed because we got to go back to maximizing employment. It's why when I ask somebody, what exactly are you waiting for when you say you want rates to come down? Like if they're thinking the last two times we saw, a prolonged period of 4% rates was a prolonged recovery from the great financial crisis. And then the next time here was 100-year pandemic. Are you waiting for one of those black swan events? And there's a lot of indications that until there's a event like that's why rates typically come down in a recession. Until there's an event like that, the Fed's not going to move on this rate that much. And he kind of alludes to that there when he talks about the labor market. We've got Nancy Marshall from Marketplace with a question on specifically housing. Let's go to Nancy's question and get Powell's response there.
Last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there.
Okay. And we've heard him say in the past, Jerome Powell say in the past, they really, when he says we don't care what housing prices are, the Fed really doesn't care about housing prices. Okay. Again, it's why there's people that use the phrase renter nation. Jerome Powell likes the fact that there are far less home sales. A 1978, as Resi Club just pointed out, level of home sales, existing home sales happening. We're at the 4 million mark, right? We just went over the projection that says we're not going to see more than 4.5 million sales at any point over the next 3 years in a given year. Existing home sales are at the bottom. 1978 levels when we had 230, 40 million people in this country, 100 million more give or take, right now. And we're at the same level of existing home sales than we were then. Jerome Powell doesn't care if more homes or if home prices go up. What he really cares about is less homes selling and ultimately finding a better deal on maybe a rental prices coming down. We've seen that now for 10 months straight. We went over that yesterday. If rent prices keep coming down, then they would prefer people just move over and rent so that they can get inflation down to their 2% target. That's all he cares about. Or, like we just mentioned before, he would have to react to a weakening labor market. So when people say that they are waiting for the 30-year fix to come down, there's two things they're waiting for. Inflation to get to 2%, which is a long, sticky road. Or number two, they're waiting for a lot of people to lose their jobs so that the Fed reacts to that. Okay. I hope nobody's rooting for number two. And that would be bad for everybody. There's a huge wave that goes through the economy when things like that happen. So if we're waiting just for inflation to get down to this number that I don't know who, they picked out of the sky, whatever it is, 2%, the path forward in a growing economy takes a while to get there. We're paying the price for all the money that was printed, all the debt that the American government has incurred over the years, and all the extra debt that they took out here in recent memory. That's what we're waiting for. So how certain are you that rates will come down is a question I'd be asking people who present that as an objection for their real estate needs and desires. I think most of them, if they wait 3 years, wait this thing out, will be pretty disappointed when they see how much competition will be in the market at a 5% rate, say, if that were to be the case. We did have some great news on inflation to double down on yesterday's news with CPI. The PPI, which came out today, Producer Price Index for final demand, was much lower than expectations, beat expectations. So now 2 days in a row, we have seen expectations on an inflationary measure beat what was expected. Okay. The Producer Price Index for final demand declined 0.2% in May, seasonally adjusted. This is according to the Bureau of Labor Statistics, which was reported this morning. Final demand prices increased 0.5% in April and edged down 0.1% in March. The 10-year has also reacted to this. I'll show you that in a bit. But here's the 1 month percent changes in selected PPI. You can see that now moving down. Okay, the 12 months still kind of running sideways on PPI. But this is anything that beats expectations is good. The markets are going to react to that in a positive way. And we saw that this morning with where the 10-year dropped down to. Okay, so I've got the last 5 days. I'll go to the 1 day here on the 10-year. And you can see at 8:30 a.m. when the PPI numbers were released, we had that sharp decline, that reaction that the market liked that. Now, probably about half of that has come back. So we're sitting at 4.281. But the market likes that. When the market liked the CPI data yesterday, what happened? We saw the same thing. We saw the 10-year yesterday go down. Okay. And obviously it came back up. I'll show you that part here. Here's the decrease yesterday on CPI, this sharp line here. Then when Jerome Powell came out, right before he came out in his press conference, it kind of went up and went a little sideways. And then this morning dropped back down on this PPI data. Yesterday, with the sharp decline on the 10-year, we got a pretty nice little decline on the 30-year fix. We got back down to under 6.98 on the 30-year fix. Now, we've seen enough information over the last year and a half to suggest that, well, you could have any piece of data on Monday or Tuesday or Wednesday that would bump this thing right back to 7.15, right? But right now, today, you've got buyers that can lock in at 6.98. The 30-year fixed weekly, for according to MBA, is 7.02. Last week's Freddie Mac, they'll come out with a new one either later today or tomorrow. Came in at 6.99. So we're really at that 7 even mark, which is better than 7.5, better than 7.25. It's going to be an opportunity for some. Getting that information out to the market is critical if you're helping buyers meet their needs. One of the needs that Jerome Powell has, as he mentioned in a much nicer way, is for unemployment maybe to tick up a little bit, not too much, but a little bit. It'd be helpful for him in his fight against inflation. Seasonally adjusted initial claims came out this week, and it was 242,000. That's an increase of 13,000 from the previous unrevised level of 229. So the 4-week moving average on unemployment was 227,000, an increase of 4,750 from the previous week of 222 on that number. So seeing a little bit of tick up here on the 4-week moving average and the weekly on unemployment. Obviously something to watch. We've seen that pull back, so anything could happen there, but starting to tick up a little bit. And as Jerome Powell mentioned, they're seeing the labor market normalize. To be prepared for what appears to be another 2 or 3 years of higher for longer on interest rates, join myself and all of BAM at BAM Mania, Circa, Las Vegas, October the 18th, Friday, October 18th. On Thursday, we're going to be having a all-day VIP session, as well as the registration cocktail hour on Thursday. This is the must-attend real estate event of the year. We've already started announcing some of the speakers, as well as early bird pricing. Sharon, president of Real, Notorious ROB, talking about all the changes. Ken Pozak on YouTube. Myself, the broke agent. Marie Lee is going to be in the house, as well as Tom Toole, Lisa Chinati, Luca Cree, Chelsea Pites, and some other. Derek Gregory's coming. Some other huge names yet to be announced. We've got early bird pricing right now, and BAMX members get an additional 25% off of that number. Grab your ticket before early bird pricing ends. We'll put the link down below. Hope to see you in Vegas. That's it for the hot sheet here for this week. Tomorrow, we'll have a new Knowledge Brokers pod over on the @Knowledge Brokers channel. Hope to see you there, and would love, mean the world to us if you would consider leaving an Apple or Spotify review if you love the hot sheet. Appreciate you if you're here on YouTube. Hope you're subscribed. And if you want to take it one step further and leave a review on Apple or Spotify, would love for you to consider doing that. Really appreciate you guys. We'll see you next time. Until then, toodaloo.